It's Friday, yeah. Weekend time, nearly upon us. Welcome to the Flow Show. Morning, guys.
Morning.
Morning. I'll try to make it today. Sorry about yesterday.
That's all right, mate. No worries, mate.
Yeah.
You've got stuff to do. You got stuff to do. We managed to cope in your absence, just about.
Just about. Good.
It was tough. But we got there in the end. Oh yeah, Friday. Oh, this has been a draggy week for me. Don't know why. I've left my house about 3 times so far this week because the kids are off school. And 2 of those were just going to the post box in at the end of me drive. The other time was at the garden. I feel I've got cabin fever this week. But that's the way it goes sometimes. That's the way it goes. Yes. Right, lots to talk about today as usual. So let's get stuck right into it. China is looking to maybe pick a bum fight with Canada or continue old bum fights with Canada. Their Vice Commerce Minister says Chinese enterprises have concerns about some of the trade practices of the Canadian government. So fresh from solving stuff with Australia, they now want to go and have a fight with Canada. Good luck to them. There was a poll done by those wacky folks at Reuters on the RBNZ, and 20 of 25 economists say that the RBNZ will raise by 50 BPs on their next meeting, 22nd of Feb. 5 of those, the rest, said that they will hike by 75 basis points, and that they will expect to hike the key rate to 5.25% by the end of June, and that's the median forecast there. Hopping across the water to Australia, and RBA's Lowe says he expects further rate increases will be needed over the months ahead. We'll do what is necessary to make sure inflation returns to the target range. And that if we saw another weak jobs report, they might reconsider if the labour market is still tight. So that slightly dovish comment in that part, but they're still obviously focused on inflation. If we need to slow down on rates, we will. We will assess the overall economic picture again in a few weeks. Here's the funny line: rates could start to come down in 2024 if we get on top of inflation. And that's funny because in 2021, they were saying that rates wouldn't rise until at least 2024. So just shows you how wrong central banks can be. Over to the Bank of England, and BOE's Peel says that the data suggests a slowdown in the pace of hikes. Now, surprisingly to some, unsurprisingly to a certain person sitting here in front of you, UK retail sales came in better than expected. Who'd have thunk it? You know where you heard that here first. Retail sales coming in at up 0.5% versus minus 0.3 expected. Core sales also, so stripping out all the fuel and bits and bobs, came in up 0.4% versus flat expected. Not exactly gangbusters numbers, not exactly numbers that would send the pound rocketing higher, but still I suspected sales could have been strong in January, and they beat expectations. So Christophe Barod, eat your heart out. Over to Italy, and they're going to be talking of bum fights. They're going to be getting in one with the EU because they want to change the rules for how they spend their aid funds. This is all the funds given out or yet to be given out. Still don't know if they've been given out over the pandemic period, these emergency funds. So they want to change the rules on where those funds get spent. Those funds were obviously given conditions from the EU. Inflation data from Germany, PPI dropping back, not as much as expected on the month, down 1% versus minus 1.6% expected, and not easing as far as expected as well. Still a decent drop from 21.6 to 17.8, but that was higher than the 16.4 expected. France CPI, I think these are final numbers, so confirming the prior numbers and confirming, a bit like Spain, that inflation actually rose in January. There you can see the HICP number, 7% versus 6.7 prior, and CPI up a pip as well over last month. So inflation pressures still evident over there. And down to that, we had a flood of ECB members over the last couple of days. Nagel says that interest rates may not yet be at a restricted level. It's a mistake to ease monetary policy too quickly. ECB Stornoas says March forecast should decide the next hikes. Schnabel said that 50 basis point March hike is needed under virtually all scenarios. So hammer and tong in their own way from the ECB there. Right, over to the US, and let's chug through the data first, because there was a big data slate yesterday. The choice numbers obviously being the PPI, and it followed a similar path to the CPI numbers, i.e. it came in hotter than expected. As I say, much like the CPI, that gave dollar yield another shot in the arm, pretty much confirming the CPI numbers as opposed to adding too much to it. Now, there was a little quirk within those numbers, and that was the fact that the prior numbers got revised higher quite significantly. So this 6.5 was revised up from 6.2%, and the core number, where is it up here, that was revised up, I think, from 5.5% to 5.8%. So if you take that into an account, PPI actually dropped quite significantly based on what the revised prior numbers were. However, on the flip side of that, you could say, well, see, PPI was much stronger anyway in the prior month. Market, as I say, didn't take a blind bit of notice the fact that it was a decent drop. It got confirmation from what it saw in the CPI numbers previously, inflation still in the pot, and the Fed to remain hawkish. Philly Fed came in worse than expected, much worse than expected. So going a bit of the opposite way to what we saw from the Empire State numbers earlier this week as well. Some of the components as well not looking too hot. Employment, 5.1% a drop there. New orders lower as well. Prices paid, a small tick up on that. CapEx down as well. That's the investment component there. So a little bit of a disparity coming in between some of the numbers. Maybe there's just some regional problems going on there. The differences between the areas, as I say, these are more regional surveys ahead of some of the main numbers that we get. Jobless claims was neither here nor there really. A little lower than expected, around about the same as last month. No real change, 4-week average 189 up 50 pips on that, so no real change there. Housing starts came in softer to kick off the month. Building permits missing expectations, although they did tick up on last month. Housing starts as well, much lower than expectations. Starts is the breaking of ground. That may be some weather related impact there. As much as some in the market were looking at the retail sales as they were impacted by warmer weather, there were still storms and stuff, floods, and still, well, winter storms happening across the US in January. So some areas may have been affected by things when you need to do some stuff as building works. Anyway, soft start there on the month. What we have seen in some of the weekly data, like the NBA, NHAB, as pointed out yesterday, is a bit of an improvement. So maybe that these numbers will start to turn maybe from February onwards. We shall see. Right, let's get stuck into all the Fed heads, because they've been dropping, and quite strong language coming from some of them. Fed's Mester kicked the show off, saying she saw a compelling case for a 50 pip hike at the last FOMC. The Fed has more work to do to control inflation. The January CPI data still showed more to do on calling inflation. Fed actions will slow growth and push up inflation. The Fed will need to go above 5% and stay there for a while, and it may take a year before we see the full effects of rate hikes. More upside inflation surprises could make policy more aggressive. but she's not ready to say if a bigger rate rise needed at the next FOMC. So had a case for 50s, but is sitting on the fence as to whether she promotes a 50 at the next meeting. Fed's Bully Bullard. Well, really what you expect from him. He advocated for a 50 bip hike at the last meeting and wouldn't rule out backing another one at the March meeting. Continued rate increases would lock in slowing inflation. Market-based expectations of inflation are now relatively low. The economy is growing faster than previously thought. Now all this has got the wet finger in the air. Banks, analysts changing their forecasts yet again. Goldman Sachs has added in another hike to their forecast and now see 3 25 pip hikes in March, May and June. They see a peak coming in at 5.25 to 5.5%. All changes like the weather, them lot and their forecasts. Hopping across to Canada, BOC's Macklin was out, pretty much reading off the script of recent lines and from their last meetings, that they've seen some evidence that hikes are starting to slow demand and rebalance the overheated economy. But they are prepared to raise rates further if evidence begins to accumulate showing inflation is not declining in line with forecasts. See some risks on services inflation as 4 to 5% salary gains are not consistent with the inflation target. So maybe just a touch more on the hawkish side as opposed to the neutral side from some of those comments. Lastly, Banxico's Heath sees a terminal interest rate reaching between 11.25 and 11.75, but says a lot can change. The rate hike cycle is nearing its terminal rate and monetary posture is clearly restrictive. Banxico, I think they hiked higher than expected, didn't they? The last 1K, they went 50 instead of 25, wasn't it?
Yeah, indeed. Yeah. And also with a bit higher inflation and also their other data are not really slipping away either. It's a bit the same scenario as we are seeing in the US, right? Therefore they hiked a bit more than expected last time. I mean, they are at 11%, which is we can still qualify it as an EM country, but being so close to the US and partially its manufacturer now, it's I think it's if they stay over 11% for a while, I don't see next week in dramatically if they stop their hiking cycle a little before the others.
Yeah, and that's a question I wanted to ask the both of you. You know, obviously we've been talking about the carry trade on and off for a while now. Players who play the carry trade, you know, and the Japanese are famous for it as well. Do you think that they're going to wait until central banks have paused before really setting themselves in the carry trades, or will they be piling in right now?
Oh, they are already in. I trust.
Yeah, I wouldn't be waiting for that.
These moves we've seen in MEX especially, those are really. I think they are just carry trades that are being put on, and of course the MEX has not only its interest rates, but as I've been saying over the course of the past months, really. Also due to the US trying to turn its back to China and Europe partially as well, it's really been taken even from when their interest rates were only at 6 or 7% or 8%. I think the market is actually well into it right now. So the question may be on the opposite. How is the risk and global economic picture going to look once the central banks stop hiking, especially those countries with ultra high interest rates like the MEX? I mean, then there may be a different question to be asked, because if economies start to falter due to too high interest rates being prohibitive for fresh investments and stuff, then it could be a case of rethinking the carry trades, which usually also always comes with a little bit of a shock. So and that would, in this case, I reckon, be a negative economic shock. Then all of a sudden, people say like, well, hang on a minute, because you can be in a carry trade and it's making you 10% a year, but if the currency loses 10% in a week, then your carry trade is gone out of the window. So
yeah,
for future,
that's my point.
yeah, but for the future,
you've got people who play FX for FX moves, and then when it gets to a point where maybe the volatility comes out, you know, like we saw sort of 2018, 2017, you get a shift then into the carry trades, because if people can't make moves in FX because the volatility's dropped, they might as well earn the money parking it in higher carry, low vol.
Yeah, that depends on the economic conditions. That depends really on data. If data hold up, your carry trade is going to be making money, because if data hold up, risk will hold up, and your carry is going to make money. But the carry, okay, there's two things, and Stelios Gerantidis rightly says that a mix of carry and expectations, which is always the case, Stelios. Stylianos, you're always going to a carry with some form of expectations, and that is that the global economy or the economy of the country doesn't collapse. Like, for instance, I'm in MEX, I'm not in Rand, because the Rand is much too dangerous. Even though it's a high yielder, the Rand is far too dangerous, because they have rolling blackouts over there. Their political situation is a bit average. Now, I mean to have read somewhere that their gold miners may not be producing as much as they would like or so, and it's the situation over there is so different than the situation in Mexico, for instance, where you can sit relatively comfortable in a carry trade. So whether it be versus euro, whether it be versus yen, and like Chris was saying, like the Mex yen has been a blinder as well, despite the yen strengthening over the past months. If you look at the Mex yen, it's still trading at pretty decent levels. I don't think perhaps people have been forced out because that 20 big figure drop in the dollar yen. But if you look at percentage wise moves, then compared to the interest rate differentials, your Mex yen is still not really, I think, in danger overall. It had this drop, right, like all the rest at the end of the year. But if you're a patient building up, I mean, your people are already building up in it again, as you can see.
Guys, as far as I'm concerned, the carry trade is mostly about timing, and you get some currencies like the MEX where you get opportunities. And I mean, look at dollar MEX from 2020, late 2020, until before this move lower started, a couple of months ago. It was pretty stable. Obviously, it's going to have some spikes here and there, but it was pretty stable. So the market gave you a long time to get to play the carry trade. Now, on other currencies, like, for example, the Turkish lira, you get very few opportunities of of taking advantage of the carry trade, because, like Kay said, you can have a 10% carry and lose 12% in a day. So it's all about timing. And personally, I have really avoid, like the plague, the carry trades which involve very, very risky currencies. And I would not characterize the Mexican peso as such a currency, but currencies like the Turkish lira or equivalent, currencies that are just going one way, and they give you really very, very few, if any, opportunities to take advantage of the carry trade. So it's all about timing, as far as I'm concerned.
Yeah. Timing and expectations, and you have to enter a carry trade. You have to look at the global picture of the country, its neighbors, its interest rate. Yes. There's a few more considerations in a carry trade than just go like, oh, I like the level. You have to do a bit of homework to get into a carry trade.
Yeah, definitely. Cool. Right. So what's been happening then? Well, as we can see, dollar yen has had a little bust out. It's broken out of the range. We're tapping on 135. there is a big option expiry at 1:35 today, so I'm keeping a close eye on that. It's fairly decent, so it could be one of these situations where we see the dollar moving or continuing to move in other pairs, but this one stays around 1:35. If that's the case, there may be an opportunity for a catch-up trade. For example, let's say cable and euro dollar are still dumping off another 100 pips. Dollar pairs are falling everywhere else, but dollar yen is still stuck around 1:35 into the expiry. That would suggest there's maybe a little bit of a options play going on, and then perhaps dollar yen will catch up once we're through that expiry. That's one of the things I look at when looking at options. By and large, they pass us by without much focus. But it's times like this, you just need to have a little look, see what's going on, see whether things are going the same way or they're going out of sync with what the rest of the market is doing. So obviously dollar yen is up, and largely because of what's happening in yields. Very strong move up to 3.9%. Bit of a line around here. As we can see, it was a former support and resistance area. Get above there, then we're potentially heading back up to the 4s, which is funny because the market seems more hawkish now than it did when rates were going up all through last year. Why is the market believing that the Fed now when it didn't believe it, or certain aspects of the market weren't believing the Fed into the end of last year, fellas?
Who knows? I don't know. I don't know.
Because it depends which side of the market that you're looking at, right? But if you look at retail traders, they only counter trade. Whatever the expectations are, they always expect that the market or the central banks will be wrong. And perhaps that is now changing. Not the case of being wrong about what they do, but having to admit that the expectations were far too dire, or the risk tilted far too much to the downside in what they expected to do. And we've seen this move on especially towards the end of last year, because everybody was expecting the dollar to collapse in 2023, was expecting the rates to collapse later on, rate cuts being priced in and everything, because the global economy was supposed to completely collapse. And well, people need, and that happens a lot. People need to revise their forecasts for the best of the year trades, usually somewhere around February, and then perhaps around May, June. Then we are starting to see the real year develop. I've seen this many times, where January, the trade of the year is already done, and then we need to reprice the whole lot from February, and that is exactly what we are seeing now. So
I don't even think it lasted that long, mate. If you remember, every bank came out with its 2023 forecast and pretty much tipped them on their head in the first 2 weeks of January.
The first two weeks of 2023 was actually going their way, right? So we had this spike in the dollar, and then it completely reversed. That I remember the first day of the year, euro dollar was 106. What was it? 106, 80, 90 or so, and we collapsed down to 105. And then from there on, January was all about taking it up to 110. And so the trade of 2023 was actually done come the end of January in their mind. And then comes that famous jobs report, then comes the CPI report, then comes a Powell, which I think he did it on purpose, not to be uber hawkish there, because he kind of, I expected or knew about those data or so, and then he just thinking that, okay, let the market be wrong, it will correct itself, and that's exactly what we are seeing now. Now, what's going on moving forward is a different story, because we have also been saying, and Stelios has been saying, things that CPI is going to come off. We can see in the next set of data everything getting reversed again, or the cracks starting to show again, which is possible, you know. I mean, with high interest rates, the way they are rising, and the market repricing. So now in this repricing, you can't forget that mortgage rates will go up and everything. So next data sets may actually show those kind of cracks. That's why I keep on saying there's two words now for me which are really paramount. We are also data dependent. What happened over the end of January, start of February, has the market to reprice everything that they were thinking for 2023, at least the start of 2023. Now, if those data turn around, you will see the same people starting to have to reprice again. So we can go to 4% in the 10s, for instance, and then you get a shitty labor report, and all of a sudden, bang, you're back at 370, 375, you know?
Yep. Yeah, exactly what we've been saying. You know, the risk now, or the risk grows. The more the data's good, the risk grows that it does turn around. And I'm still of the mind. There's still something in the back of my head that says there's perhaps a lot of one-time effects in those January numbers, the CPI, PPI, the jobs numbers. So I am going to be concerned when we get the next set to see if it does all reverse, and then you'll get Goldman Sachs lopping off their extra June hike. And we'll all start pricing cuts by the end of the year again. Good in one sense, because this gives us plenty of volatility to trade. You know, the data matters, and it's going to give us the moves. But you've got to be ready for it, and you've got to be ready, as we said yesterday, you know, to switch your thinking around. It's okay sitting here now thinking, yeah, Fed's going to hike, carry on hiking, rates maybe above their ceiling, buy dollar dips. If that data turns again, you've got to be ready to turn as well, and let the price action tell you whether it's going the other way or whether it's just taking a pause. Going to be very important, these data points, and we love it. As I say, it brings us the volatility. So anyway, back to the prices. So we are going to be watching yields a lot for what happens in dollar yen and the dollar in general. As you said, dollar yen is having a break up now, so we're going to potentially be looking at the upside. If we get and hold through 135, I'm going to be folding out my shorts that I've got further down below, because I think I'm pissing into a very strong wind, and I don't want to let it get too far away from me. I'll come out small down on it because I was taking profits every time we saw dips. So I did put some in the bank. I'll give some back. But not as much as if I had the whole positions on from the start. So above 135, if we're holding it, I'm probably going to fold out of those, reassess, see what happens, maybe pick some higher levels to look at for trades, and potentially when things start to turn again. Obviously, the Bank of Japan is still a big key component in all of this, and obviously that's going to be big for dollar yen as well. For me, the waters are a bit more muddy at the moment. They were pretty clear coming into this year, even in the early part of the year, pretty clear. But now things may be changing, so I need to keep an eye on that. Aussie dollar finally did what I was waiting for it to do, and I'm not on it yet again. We had 3 goes at trying to crack this support. 3 times we failed. The 4th time we've done it, broken it, held as resistance, broken the next level, held as resistance, textbook break, as you're going to see. And now we are going to be heading lower. As I suspected for the last couple of weeks, it's been more bearish than bullish on this one. Next big level for me is down into 68 and down to this batch of fibs down here. So quite a wide area, a bit of traffic zone. That 67, 80, 60 area. So the first line is going to be in at 68, and then that area there. If we do get through there, the next big level is down into the 67s and mid 66s. That's around that 50 fib. If we break that, then for all intents and purposes, the rally that we saw since October is probably over, or going to be a bit more balanced. If we hold in these levels, then we keep this rally in play, and maybe we get a move further back up towards that 70 handle. But for now, the trend is your friend, and the market doesn't want to give the Aussie dollar any more room to the upside. So further downside is probably set from here on in. Let's see how far we go on that one. Euro sterling, still keeping my longs back into 89s. That keeps us on for maybe another move up towards these highs to see if we get a move finally to that 90 level that we've all been waiting on forever and ever. Coming out a bit longer, you can just see if we do get above that 90, there's potentially some clear sky well up to the 92s, 93s. If we do find ourselves up there, I will be looking to build a short position into that, purely because it is a very long-term range area. The price likes to sit around in these 80s, and when we get extensions, it doesn't last long. Obviously, you have to take each trade as it comes. So if we do get up to those 92s, 93s, I will be looking at the reasons why, and whether it's valid to get into shorts just to play the longer term ranges up there. Dollar CAD was one I was looking at. I had a bit of interest to maybe tap it up in 135, but we've gone straight through the prior. It's coming a bit shorter. As you can see, we've got the DMA up there, the 100 DMA up there, pretty much bang on where we are now, 135.18. But looking at this coming in a bit shorter, this was a prior high area, and we were knocking our heads around this 134s, 60s, 70s areas. We made the break, gone through 135 quite easily. So potential for a break to be on here. If it starts to build above that moving average, the 100-day moving average, and above this fib, then potentially it's confirming that break and it might move on. But for now, it's just not decisive enough for me. It's thinking about it, but not quite getting there. So that'll be the key there. Maybe I'll look at a short if we get back under that fib, maybe the 135, and it starts to become resistance again. Might mean a little bit of a fake out on that side. But as I've said this week, you need to know what sort of wind you want to piss into, and the dollar's looking very strong at the moment. So if you're going to fight it, know your battleground. Reduce your trade size, make your stops a bit tighter. Don't give yourself as much room to be wrong on this side as you would maybe buying the dollar. Guys, do you want to have a look at anything?
Stelios, perhaps, I don't know. Stel, do you want to?
I can, yeah.
Or do you want me to put up the charts and then you talk about them?
No, it's okay. I mean, I don't have that much new to talk about, but I will put them up a little bit. And
while you're doing that, I'm going to reply to Rob and say, if rates are supposed to matter, then how has Swiss been so relatively strong for years? Because it's the most expensive parking place in the world for money that doesn't want to be seen, and for richest money. And thanks to an economy which is holding up, and they're being neutral in every conflict and everything. It's like, yeah, the rich man's parking place for money. It has diminished a little bit, but it's still very much the case.
True. Okay. So, well, we've been talking about yields for a while. We had the breakout from this trend line, and that was the day before the CPI. So we're saying, yeah, maybe not, or a couple of days before, maybe not make too much of it, but it's been confirmed. And you know, for those who are ForexAnalytix subscribers, I had my my macro bias for yields on bearish for quite a while. Then after we reached this high, I moved it to neutral, and after this break, I'm now back to bearish. So for me, this is a game changer, at least for the short term. And I think now we're testing these highs. I think most likely we're going to be heading towards that 433 high, and I'll be talking about this for a few days now. So with yields rising, what's the next logical move? Well, that is my trading is so slow today. I don't know why. Next logical move is to see a move lower in stocks which are still resilient. The wicks have been, you know, the trend has been a sell-off in European hours, and then New York comes in, and then they kind of recover most of the losses. It was still moving down a little bit, but really it's not convincing yet. I think stocks should be heading lower, especially with yields going higher, but they've been resilient. So I'm not outright bearish yet. But I think the path of the problem I have is that this trade makes a lot of sense to be short stocks with the current economic environment, with the Fed perhaps turning more hawkish, perhaps doing more hikes, and perhaps staying at that terminal level for longer. But it makes a lot of sense, and that's the problem, because I think everybody who looks at stocks wants to sell them. And I think that's one of the main reasons why stocks are not really getting any momentum lower. So stocks, I think, should be sold, but I'm not sure about the levels yet. I would prefer a nice little squeeze into the 4200s before I consider that. But as a macro viewpoint, definitely not good for stocks or risk assets in general. Apart, it seems, from cryptos, which are no longer correlated with risk. And they're doing very well recently. And look, today again, stocks down, Bitcoin up, and we had a very big move a couple of sessions ago, and we're consolidating. So I think that if we do see I think the risk is going lower. But if we don't see that, I think then big cryptos explode, or at least Bitcoin goes up towards this 28,000 level, which was support before. It's a little fib as well. There's a lot of confidence there. I think that's the next level, unless we break down in a big way in stocks. But even though, even with that, you never know. Cryptos are still doing well in the face of rising yields and falling equities. So, kudos to those who are long cryptos, because they've been outperforming very nicely. Metals are not looking good. We were talking about that, and with yields going higher, the knee-jerk reaction is always first to sell metals before anything else. That's been the reaction, and it's actually very perverse in my opinion, because why is the Fed raising raising rates? Because prices of everything is going higher. Everything apart from apparently one of the most useful elements in the world, which is silver, used everywhere. There's a big deficit this year, and it's projected to last for the next couple of years as well. But still, it doesn't matter. It's useless, and it's being sold. Obviously, I'm being ironic, but in the face of rising prices of everything, just metal selling off, it's makes no sense in the short term. But hey, it's okay. We're patient. We're going to get nice entry areas. I'm happy that I unwound my longs on this last leg higher here. If you remember, I have taken a very small quarter position only long at 2250. My next trigger level is here, 2105 probably. I'm going to put that in. And then the remainder of my long, I'm going to probably put in the high 18s, low 19s if we get there. But, the short-term view is not good for metals, and that's why I'm holding off and I'm not doing much at the moment. We are quite oversold. RSI is below 30 now in silver, and theoretically there should be some kind of reaction as we get to support levels. Why is my trading view so slow? I really don't know. It's still loading. Oh, there we go. So let's have a look. Silver, the levels are... Sorry?
I was just going to say on silver that I've also, on my update this morning, taking a look around the markets, I also saw this 20.5, 20, low 21 zone on silver could be an interesting one, depending on where the yields end the week, or what the dollar is doing for this afternoon or so. We could be coming close to interesting levels, for me at least, because I've done like you up to those 24 and a half. I've offloaded a lot of my long-term and shorter-term plays, and since then I've just been waiting. And but we're coming to levels where it starts to look interesting to me at least.
Yeah, I know, I agree, and I think it's important to be nimble and to not marry the position. I am married to my bias, that's for sure. Unless things change economically in terms of how governments work, and how deficits are being created everywhere and funded by debt. I mean, unless that changes, my macro thesis for metals, for any kind of metal really, is bullish. But I will not get married to the position. So I got long. If you remember in the what was it, 21s, I lobbed them out 23.5 to 24. And I plan to do that again. And maybe I was a little bit early on my first quarter position, but the way I traded is not the way most people do. And I'm not leveraged, and I'm very patient with my entries, and I accumulate slowly, and then I let it go slowly. So I think this level around 21 is very interesting. Could we go through? Of course, we could go all the way through down to 19s. I mean, it would be an absolute gift if we go there, because for me, it's a very simple trade. But the problem is how do you execute it? That's the thing. Is very, very volatile. It can really take you out if you're leveraged, if you're early, etc. So
exactly, because if you look at the move from the highs we've printed a few weeks back, and then here it's 15%. No? It's not something to spit on, or at least like 10-12% or so. Those moves in those metals, and especially silver, can be very wild. So we have to be careful with our amounts and leverage, if any.
Absolutely. So gold is a similar picture. We have this, what is it, 200 DMA around 1770, 1780. We're getting close. We're about $40, I think, from areas of interest. Those previous highs here, previous lows. So this area around 1780 to 1800, I think, is an interesting one. Currencies, nothing's changed. The euro is, as long as rates are going higher, the dollar should be rallying. And even though we do get the occasional ECB, not occasional, we do get ECB relatively on the hawkish side. They've told us that they're going to be doing 50 on the next one, maybe the one after as well. They're still seeing high inflation. And for once, the ECB is ready to act. So I haven't seen this since Trichet. And so short-term move, I think we're going lower in euro dollar, and I think the dollar is going to be rallying pretty much against everything. But I hope the move lasts so that we get to levels that look good to take counter trend. I've been talking about this trend line here in dollar Norway, just under 1040. We're getting to it really, really quickly, and with this momentum, I don't think I want to be going against it, even though it could be worth a shot, but I don't know. I'm not convinced yet, so I'm not going to touch it. Dollar MEX is the one I'm looking at on a potential breakdown, but we actually did momentarily break down below the lows, and the lows from back here. Come on, TradingView. And we just got to right back up again. So maybe we got we suckered in a few shorts. Here we go. These lows here we took out. Maybe a few shorts were suckered in, unfortunately, and we're back up again. And this is definitely a trade I want to take to the short side for the carry, for everything. But I want a technical breakdown, maybe a breakdown retest. That would probably be the best one. So apart from that, not much has changed. I still think Euro Pound is going to be hitting 90. So I think it's going to be taking out these highs, hitting 90, and then really, where do we stop? A lot of people are talking about 92 to 93. I think you guys mentioned as well. Makes a lot of sense up there, but I don't think we'll get there. I think it's all going to be over before the 92s. So anywhere up between 90 and 92, I'm going to start looking to accumulate some shorts. But obviously, it's going to depend on economic data, on the macro picture, because I play this pair not on a short-term basis. Look at this. I mean, from 2016 until now, it's been a very, very clearly defined. Basically, from the referendum, right? The pound lost a lot of room, a lot of ground, and then it's been just going 82 to 92 or 82 to 93. So I really, really would love to see this at 93 again. I doubt we'll get there, but I'm going to start loading up some shorts I'm not going to overdo it once we get there. But you know, the 90 level that I've been talking about since what, 84? We are almost there. I think we're going to get it. That's it. I don't have much else to say. Hopefully, I'm not boring you too much with the same stuff, but some things are changing, some things are not.
Yeah, no, that euro sterling is a nice one if you've got the patience for it, and boy, it can test your patience. Even if you're trading it short term, it can test your patience. So yeah, thank you for that. Okay, you can have a little whiffle around.
Yeah, I'm not going to cover again what Stella's already showed. The only one, because I just want to show that I'm looking at pretty much the same picture in silver, and giving the people the reason why I think this 20.5, 21 is not too bad an area. Look at the traffic that we have had in this since 2022. It's always been an area of interest to the market. And again, I'm patient because I think the dollar may put in another leg, especially if those US 10s go to 4%. If the US 2s are breaking above the prior high, again, for me the prior high is around here. This one I think was a fat finger or so. I don't think we've ever been there in November. Yeah, so back to this silver, I think this is really a zone of interest, and I may start to very, very slowly reaccumulate what I've let go on the way up. So I'm pretty much on the same page as Stelios, and I know that people think I'm crazy to think about that, but the fact that Brainard is going to be one of Biden's advisors, and knowing her opinion about stuff is that she may be pushing him a little bit harder into those infrastructure deals or plans or whatever. And if that's the case, and if and I always say, for silver to outperform gold, for instance, the economic conditions cannot be bad, because if the economic conditions are bad, gold will outperform silver usually. Okay, because silver has this industrial is an industrial metal. It's used for basically everything. So this zone is starting to be a little interesting in my view. Euro dollar short term, bit of a zone here where we are in this 106.30. Now. I'm looking at euro dollar, but I haven't been trading euro dollar that much of late, because I'm rather in some crosses than in the euro dollar, because ECB's hawkishness. But yeah, if we get below here, we may have a look at 105.80, and why not even low 105s this afternoon. And I'm saying that because this is relatively the first day of the week that the dollar did not correct in the European time zone. The Europeans have been quite reluctant to buy dollars so far this week. It seems that they are either slow or they need a lot of persuasion to buy dollars. But today, the dollar is holding up well in the European time zone, and that is one to note. If we don't get over the noon fixing, also if we don't get a recovery or a setback in the dollar, my thinking is, at least short term, that we are going to see perhaps a Friday pain or final, or I don't know, but perhaps we're seeing another rally in the dollar this afternoon, just based on the price action not giving back basically anything, and on the yields either, it's not giving back much. Cable then, yep, we've broken below this bit of a trend line, 120.70. I spoke about that, had the retest and couldn't hold it. So now we are already below what I am always looking at in the short term, at least 119.70.80. We are below there now. Let's see if we are going to have a retest when the US walks in around 119.85. I think is already the first level to pay attention to. But if we start to go back, break below the figure, Can't rule out a revisit of those very early January moves, and then perhaps, I don't know, but it's 170 points away or so. But on a Friday, who will tell that we can't do them? To me, this 117.60, 40.60 zone has been a clear zone of is the sterling or cable gonna hold or not? And if ever we're getting down here, depending on where the yields are and where the yield differentials will be, this to me is going to be my, at least, personal important zone, 117.40.60. I've always had something with that level, and it's been a level of traffic and changes of directions, continuation, retests, and et cetera, et cetera. So that's important. I'm not going to recover euro sterling. It looks like I think all those ongoing strikes and the market perhaps not being a very supportive for the Bank of England. That's not helping the sterling. Dollar yen firmly back into the daily cloud, and people are talking about this 200-day moving average. I've seen it, okay? I've seen this 200-day moving average, but look at what it did historically. That means not a lot, right? It's never been a real stopper. Perhaps here and there, perhaps for a couple of days, but then I've seen the market talk about it. But what's interesting is that the 100, which have been a breaker at times, the 100, is it the 100 or is it the 55? It's the 100. Is going to be up there as well, and they may start to converge with the top end of the cloud. And if you look at this, it's now around 136.90, around 137. But next week it's moving down, okay, and they may converge. And what's happening next week on the 24th? It's the hearings for Ueda and friends to see if he is going to get the new Bank of Japan governor role. So if ever we trade around the top end of the cloud at that day, that's going to be one that I'm going to pay extremely close attention to. So that for the dollar yen. In the meantime, we've broken above the prior levels. We are now trading above 135. There are those big expiries today at 135, the figure which could keep it here around 3 p.m. London time, UK time, 10 a.m. New York, but keep an eye on what's happening afterwards. If we close the week back below 134.40, the short-term traders may think that we are in a failure territory and we may get a move back down into the 133s. For the time being, I don't have anything. I'm a bit long euro yen, but I don't have any dollar yen because I think perhaps those options may do something. I have a couple of other stuff still on, and we'll see. It was my target on the dollar yen, 134.5, 135. So I've taken my last bit of this morning in the 134.90s, and that's it for now. Yeah, euro yen held where it had to hold last night. Was coming back to retest this zone in the high 142s, held it, and we are back above. I'm still a bit long, managing it around a bit, and I'm also patiently waiting 3 p.m. because the dollar yen expiries could have an impact on all the yen crosses as well. Now, this being said, on those option expiries, yeah, I mean, I've seen you guys on the chat already mention the amount. So yeah, we are above the $3.5 billion zone. That is pretty decent. So there should be some activity around here, but the activity should be concentrated around here. If you start to move 20, 25, 30 points away, the magnetism of the level is going to wane. Okay, so don't attach more importance than we have to big strikes in options, because me having been trading a lot of them as I was the hedger for the options desk for many years, I've seen $5-6 billion options having absolutely zero impact. So be a tad careful. but take it into account because it's big enough. Okay. So that for the euro yen, as long as we hold above 142.75, I think it's relatively positively oriented still. Again, time will be of importance as well. If we manage to keep grinding higher, when we come to end of next week, I'm going to move out of the position because I just don't want to have the risk for when we have those parliamentary hearings for the new Bank of Japan governor. I'm going to move quickly because it's time. Yeah, time. Yeah, dollar CAD was one that I spotted this morning. We are right on resistance here. So 135, 2025. We are right on the resistance. If McClem wouldn't have been so balanced and even sometimes sounding a little bit like we may be at the end of our hiking cycle, I would have counter traded, perhaps not dollar Canada, but something like the euro Canada, because we are at intermediate resistance as well. But I'm going to hold off until the end of today, and I would feel a bit more comfortable with this euro CAD. Perhaps if dollar CAD breaks, with this euro CAD around 144.5. This is probably worth having a look at, just for a short-term counter trade again. What else? Yeah, the commodity currencies are not feeling well, right? Ryan already showed it. We are breaking level after level, and looking at the dollar, it's still not giving back anything. Actually, if anything, it's strengthening again a little bit. Euro coming down a little bit again. Why not go and have a test at the mid 67s before the week is over in this Aussie? We need to get back now above already 68, started 30, but then 68, 65, 85 to get back into more positive territory. So before the week is over, there is a possibility that this is going to test mid 67s. Kiwi, similar, was holding yesterday just, and then we had this little spike, sold into it. And I've covered a lot this morning in this zone, for keeping a small bit open. Again, same thing as the Aussie. It's losing level after level, and why not have a move down into the mid 61s before the week is over? If this 62, the figure is giving way. Yeah, so basic idea is still strong dollar for me to end the week, unless there is something dramatic happening and the yields start to falter in the US. Be careful on this dollar mix. We've had 3 attempts now to break sub this 1850, sub the trend line as well. We had already 3 attempts, and the market is forced to buy back a few dollars. So for as long as this holds, and I would stretch it to around 1840. I would stretch it to around 1840 because of this low here. We have been like hanging around, and then we had the big spike, and this low is around 1842-ish something. So give it another 0.5% if you want to really trade this one on a break. The same thing happened in Euromex. 1975 is the level I've been watching. It's holding, so I've been managing my position a little bit less short. Let the weekend, and then see what happens next week with carry, with risk and stuff. And with that, I am going to give it back to you. Let me quickly read. Well, Mike, we cannot read too much in today's price action. It all depends. If the market is forced to continue to reprice yields and dollars, we may see a pretty big move this afternoon. And actually, not having any major data out of the US nothing stands in the way of any move. That's what I mean. So we could see a sizable move.
Where we close the week, it can be important as well, because it gives momentum to these moves if we
absolutely,
go strongly.
Absolutely. All right.
Cool.
Giving it back to you, man.
Thank you, mate. I'll just grab it quickly because Jordan says that oil's looking a bit heavy again. And yeah, this one continues to baffle me a bit because, you know, if we're heading for soft landings, no landings, better economies, China reopening, then, you know, commodities like oil should be doing better, and they're not. So it is a bit of a strange one. But if you want to trade it, we've got a pretty decent range here. You're potentially going to be looking at long 72s down to the 70 handle, letting them go if you get up to the 80s. You know, a decent range to trade inside there if it's going to walk from edge to edge. Obviously, that's at the moment is a double wind for dollar CAD moving higher. Obviously, strong dollar, weaker oil.
Yeah, Ryan.
The perfect storm. Yeah.
Are you trying to share a screen or not?
Can you not see it?
No, nothing showing.
Yeah, it's not started yet.
Oh,
Again.
let's try that again. It's showing on my thing. How's that? No?
No.
No. It says I started screen sharing, but it doesn't show. Maybe it's ours.
Something's gone wonky with Zoom then, because it says you are screen sharing. I can see my little icon of the screen.
Yeah, it says it starts, but
well,
anyway,
maybe
it's your cue to wrap it up.
Yeah, maybe the meter's run out. I didn't put another 50p in. So anyway, those of you on the chat room can come and see us over there, and I'll throw up the oil stuff maybe over there. But you get the picture. You've all got your own charts anyway. Suffice to say, thank you everybody for coming to the Flow Show this week. Been a busy week again. I hope we're doing you proud with our analysis and our views, helping you to navigate these tricky markets. Thank you as always to my two colleagues, Stel and K-Man. Awesome stuff as always. Have a very great rest of your day and a very lovely and peaceful weekend. Thank you very much.
Cheers, everybody.
Bye-bye.